What is the Warren Buffett Stock Market Indicator? The Warren Buffett Stock Market Indicator, also known as the market cap to GDP ratio, is a measure of the total value of all publicly traded stocks divided by the GDP. It is used to determine whether the country's stock market is overvalued or undervalued in comparison to a historical average. In recent years, the stock market cap to GDP ratio has become known as the Buffett indicator, after Warren Buffett stated to Fortune magazine that it is probably the best single measure of where valuations stand at any given moment. He says this because it's a simple way of comparing the value of all stocks on a combined level to the country's total output, which is its gross domestic product. The Buffett indicator's shortcomings. While the Buffett indicator is an excellent high-level metric, it does not consider a company's profitability, only its top-line revenue, which can be misleading. Furthermore, the ratio has been trending higher for a long time, about the last 30 years, leading many investors to wonder what a reasonable average ratio should be. While the average is 75%, and many believe that anything above 100% indicates that the market is overpriced, others believe that the new normal is closer to 100%. Finally, trends in initial public offerings and the percentage of publicly traded companies influence this ratio compared to those that are private. All else being equal, if the percentage of companies that are public versus private increased significantly, the market cap to GDP ratio would rise, even if nothing changed in terms of valuation. This ratio fluctuates over time because the stock market's value can be very volatile, whereas GDP grows much more predictably. Historically, the Buffett indicator hovers around the 100% mark. It was less than 30% during the Great Depression and briefly in 1982. The highest marks were obtained in 1929 and prior to the dot-com crash in 2000. The current value of the Buffett indicator indicates that stocks are not cheap. In summary, when the value of all stocks is 80% or less than the size of the economy, buying stocks is likely to work very well for you. But when total equity value exceeds the size of the economy and then some, it is a sign that investors are getting greedy.